Hello, all. I'm Mamta Rawat from the Corporate Communications team at CareEdge Ratings, and it's my pleasure to host today's webinar on unsecured personal loans and Fintech NBFCs, navigating growth and profitability. Thank you for taking the time to join us. Before we begin, I'm delighted to introduce our esteemed panel of speakers. Mr. Siddharth Vishwanathan, Chief Risk Officer at CreditB. Mr. Nitin Gupta, co-founder and CEO at Finable Credit Private Limited, and Mr. Vimal Sabu, CEO at Early Salary Services Private Limited. This session will be moderated by Mr. Vineet Jain, Senior Director at CareEdge Ratings. We will begin this webinar with a presentation by Mr. Tony Matthew, Assistant Director at CareEdge Ratings. After the presentation, we will move into a panel discussion followed by an audience Q&A. For any questions, please type them into the chat panel. We will address them towards the end of the session. With that, may I invite Tony Matthew to begin the presentation.
Thank you, Mamta. And a very warm welcome to everyone joining us today for CareEdge Ratings webinar on unsecured personal loans and Fintech NBFCs, navigating growth and profitability. Over the past few years, the unsecured personal loan segment has witnessed rapid expansion, accompanied by a growing presence of NBFCs in this space. Regulatory changes over the last couple of years have also influenced the sector's growth trajectory, and we believe these measures have played an important role in balancing growth with risk. In today's presentation, we will first look at the overall trends in the personal loan segment across different classes of lenders. Following that, we will take a closer look at Fintech NBFCs. During this session, we will walk through the major trends shaping the sector, including growth patterns, asset quality dynamics, profitability metrics, and the evolving funding landscape. We have put together a short presentation to set the context for our panel discussion. Share their questions through the Q&A box, and we will address as many as possible during the discussion. With that, let me begin the presentation. Let me briefly summarize the key messages from this presentation. Growth in unsecured personal loan is beginning to moderate as the lenders are adopting a more cautious stance. We are seeing a notable shift in the market share of NBFCs, while banks increasingly focus on higher ticket and relatively stronger borrower profiles. NBFCs, especially fintech-led players, continue to drive growth in granular, small-ticket personal loans. Fintech NBFC remain relatively more active among early cycle borrowers, that is typically young customers with limited bureau vintage and relatively lower credit scores. The capitalization level across care-rated Fintech NBFCs remain comfortable. Steady equity infusions, internal accruals, and prudent on-book leverage have strengthened balance sheet resilience. Capital market borrowing dominates the liability side of care-rated Fintechs, and the growth in AUM is also supported by co-lending partnership with banks or off-book portfolio. Profitability metrics and ongoing regulatory interventions remain important monitorables. Regulators have taken proactive steps to mitigate the systemic risk in the unsecured lending ecosystem. As a result, the operating environment is expected to remain supervision intensive, particularly for fast-scaling fintech platforms. In this slide, we look unsecured personal loan segment at the aggregate level, covering both banks and NBFC. In the chart on the left, the total AUM of unsecured personal loan has nearly tripled in the last 5 to 6 years, from 5 lakh crore in March 20 to 15 lakh crore as of September 2025, registering a CAGR growth of around 25%. The growth slowed down significantly to about 9% in FY25 from 32% in FY23, mainly due to a more cautious approach from lenders and regulatory tightening. In the first half of FY26, growth has picked up slightly with an annualized basis growth rate of 12.4%. The right-hand side chart shows market share by type of lenders, and the others category in this chart and in later slides include regional rural banks, small finance banks, and foreign banks. While banks continue to have the largest share, NBFCs are steadily gaining ground. The share of NBFCs has grown from 15% in March 21 to 24% as of September 25. Banks, private and PSU together have 70% market share, down from 80% in March 21. This slide shows the disbursement trends in the personal loan segment. The left-hand side chart shows the lender-wise distribution of disbursement value over the years. disbursement have increased steadily from 3.7 lakh crore in FY21 to 8.8 lakh crore in FY25 and already reached 5.1 lakh crore in first half of FY26. What we see here is gradual but clear shift in origination patterns. NBFCs have been increasing their share of fresh disbursements, while the share of both private and PSU banks has been moderating. To put this in numbers, NBFC's share in disbursement value have moved up from 16% in FY21 to about 37% in H1 FY26. Over the same period, private banks' share declined from 32 to 25%, and PSU banks' share fell from 48 to 36%. The chart on the right shows the disbursement trend in count terms, that is, number of loans disbursed. In H1 FY26, NBFCs accounted for nearly 92.5% of all personal loan originations by count, and Fintech NBFCs alone contributed around 80%. This underscores their dominance in the small ticket short term segment, enabled by digital acquisition, seamless onboarding, and faster turnaround times. Let us now look at how average ticket size has evolved across lender categories, as this gives useful insight into how risk appetite is shifting within the system. The chart shows the lender-wise average ticket size from FY20 to H1 FY26. Starting with the banks, both public sector and private sector banks have gradually moved up the ticket curve. The most notable move is in the average ticket size of PSU Bank, which has more than doubled in last 5 years from 3.4 lakh to 7 lakhs in September 2025. Even for private sector banks, average ticket size has increased from around 3 lakh to nearly 4 lakh over the same period. In contrast, NBFCs continue to operate at much lower ticket sizes. The average ticket size has remained broadly in the 25,000 to 30,000 range. From a credit standpoint, this segmentation matters. Higher ticket loans means greater exposure per borrower, but are typically associated with more stable income and stronger credit histories. Small ticket, granular portfolios diversify risk across many borrowers, but are generally more sensitive to income shocks and broader economic stress. Let us now look at asset quality represented by PAR numbers. In line with the earlier slide on broad market segmentation, we can say that there is an inverse correlation between average ticket size and PAR data. On the left, the lender category-wise PAR 31 to 180 trend shows that as of September 2025, NBFC PAR 31 to 180 is at around 3.59%, private banks at 2.4%, PSU banks at 2.18%, with the overall average at about 2.7%. NBFCs continue to show higher stress than banks, largely because of their borrower mix and smaller ticket size focus. On the right, the ticket size view reinforces this pattern. Loans below rupees 1 lakh have the highest delinquency. PAR 31 to 180 in this bucket has improved from 7.1% in March 22 to about 5% in September 2025, but it still remains the most stressed. Delinquency steadily declines as ticket size increases, showing a clear inverse relationship between loan size and PAR. Since Fintech NBFCs have a larger share of sub rupees 1 lakh loans, this explains why their overall delinquency levels remain higher than those of banks. While the earlier slide highlighted the average PAR 31 to 180 at around 2.7% and has been declining, PAR 180 plus continues to rise, increasing from 3.1% in March 23 to 5.6% in H1 FY26. This indicates that recoveries become significantly harder once loans slip into deeper delinquency buckets, and a growing share of accounts are getting stuck at this stage. So far, we have looked at data for overall unsecured personal loans. Now we shift our focus to Fintech NBFCs. Fintech Association for Consumer Empowerment, which is SRO for sector, defines Fintech NBFCs as entities that originate loans primarily through digital lending platforms. Let us now focus specifically on the growth trajectory of Fintech NBFC within the personal loan segment. This slide highlights the steady increase in the Fintech NBFC AUM over the past few years. Fintech NBFC AUM has grown from 57,000 crore as of March 23 to 1,28,000 crore as of September 2025, depicting a CAGR growth of 38%, while other NBFCs have grown a CAGR of 27%. The share of Fintech NBFCs in the total personal loan AUM increased from 5.3% in FY23 to about 8.3% in September 25, and they now account for nearly one-third of NBFC personal loan AUM. So while Fintech NBFCs have demonstrated strong scalability and growth momentum, the portfolio composition and asset quality trends remain key monitorables. This slide highlights the borrower profile of Fintech NBFCs, which help explain their asset quality outcomes. On the age profile on left-hand side chart, about 14% of Fintech NBFC loans by value go to borrowers below 25 years, compared to 5% for other NBFCs and 3% for banks. Nearly 60% of Fintech loans are to borrowers below 35 versus 39% for banks. Similarly, the bureau score profile on right-hand side, Fintech NBFCs have around 14% borrowers with no bureau score and about 50% with scores below 644. For banks, these are at 6% and 25% respectively. From a credit risk perspective, this borrower mix explains why Fintech-led portfolios tend to show higher early bucket delinquency, and Fintech have supported financial inclusion and market expansion into underserved segments. So we now present select data for care-rated Fintech in the unsecured personal loan segment. Let us now look at the growth and portfolio mix of care-rated Fintech NBFCs. On the left chart, we can see their total AUM has grown strongly from 7,000 crore in FY21 to 37,000 crore in FY25 and further to around 44,000 crore in H1 FY26. Growth slowed a bit in FY25 but picked up again in H1 FY26, and we expect this momentum to continue with around 27% growth projected for FY27. On the right, we see a clear shift in the on-book versus off-book share. In March 2021, about 92% of the portfolio was on-book. By September 2025, this has reduced to around 69%, with the off-book share rising to about 31%. This reflects increasing use of co-lending and risk-sharing partnerships, which help these players scale in a more capital-efficient way. The impact of recent regulatory changes in CLM will have to be monitored. Let us now look at profitability trends using the ROMA chain. NIMs, including other income, have remained strong, though with moderation from 20% during FY21 to FY24 to 16.5% in H1 FY26. This softening reflects higher competition and some pricing adjustment given the noise around higher rates charged by fintechs. OPEX as a share of average managed asset has improved steadily from 10.8% in FY21 to about 7.3% in H1 FY26. This improvement comes from the better operating leverage as the book grows. Credit costs remain high compared to secure lending, but they have stabilized. They stand at around 5.9% in H1 FY26, well below their earlier peak levels. When we put all of this together, stronger cost efficiencies and stabilizing credit costs, we see stable ROMA of 2.5% plus or minus 20 basis points over the last 4 to 5 years. We expect ROMA to remain healthy, supported by scaling up better borrowing costs and stable credit costs. In this slide, we briefly highlight the role of equity market, debt market, and co-lending partnership in supporting the growth of Fintech NBFCs. Starting with the equity capital, the sector has historically been able to attract equity investment, although the pace of fresh equity inflows has slowed in recent years. As a result, on-book gearing for care-rated Fintech NBFCs stands at a moderate 2.14 times at the consolidated balance sheet level. A major driver of growth has been co-lending partnerships. Under this model, Fintechs source and underwrite the customer, while a larger lending partner, either a bank or an NBFC, books a significant share of the loan. When we look at the gearing at the AUM level, including off-book exposures, it stands at 3.41 times as of September 25, reflecting the scale achieved through this partnership. On the right-hand side, we can see the debt capital market contribution and the evolving funding mix. Debt instruments, NCDs, securitization, and commercial paper form a significant portion of on-book liabilities, accounting for nearly half of the funding mix. In the chart, commercial paper is captured within the others category. We also observe a notable shift in the funding sources over time. Bank borrowings have increased from 23% in FY23 to about 37% in H1 FY26. And the share of NCDs has risen recently, indicating broader access to capital markets. Overall, leverage remains manageable, supported by equity infusions and diversified funding channels. However, reliance on external lending partnerships continues to be an important structural feature of the model. FLDG outstanding is around 4.4% of net worth, providing comfort from a capital buffer standpoint. This brings us to the final slide, our key takeaways and the outlook for the unsecured personal loan segment and Fintech NBFCs. First, the sector is moving from rapid expansion to more calibrated and risk-balanced growth. Better data availability, improved underwriting practices, and refined risk scoring models are helping lenders strengthen portfolio quality. Second, even though credit costs remain elevated, high portfolio yields continue to provide a cushion. This reflects the inherent risk-return trade-off in unsecured lending. Sustaining yields while maintaining underwriting discipline will remain critical. Third, the capital position of care-rated Fintech NBFCs is comfortable. The capitalization appears adequate to absorb volatility and support steady growth. Fourth, the margins have moderated. Controlled operating expenses continue to support returns, even as credit cost volatility remains a key sensitivity. Fifth, we are seeing a gradual structural shift toward unification of fintech platforms and regulated NBFCs in the same legal entity. As scale becomes more important, factors such as compliance agility and customer centricity will increasingly differentiate players. Finally, access to funding, profitable growth, and a regulatory policy stand will be the key forces driving outlook for fintech NBFCs. With that, we conclude our presentation. Thank you for your attention. I now hand it over to Mamta for the panel discussion.
Thank you, Tony, for that comprehensive overview. A quick reminder to all the attendees, please keep sending in your questions. We'll take them up during the Q&A. Now, I would like to invite our moderator, Vineet, to take the discussion forward. Vineet Jain is a Senior Director at CareEdge Ratings. He's a qualified chartered accountant and company secretary and has over 25 years of experience spread across credit ratings, structured finance, debt capital markets, and corporate banking. He was part of the founding team of IDFC Bank and was instrumental in setting NBFC lending business as part of the FIG, Financial Institution Group. Over to you, Vineet.
Thanks, Mamta. Good evening to all the esteemed panelists and all the participants. A very warm welcome to all of you. Thank you, Tony, for the informative presentation. We are honored to have three esteemed panelists, and I thank all of them for being part of this panel discussion. And I believe that we will all benefit from their valuable insights. Please note that the views expressed by the panelists here are their personal views and may not necessarily represent the views of the institution that they are associated with. I would now quickly introduce our panel members to the webinar. Our first panelist is Mr. Nitin Gupta, co-founder and chief executive officer, Finable Credit Private Limited. Nitin is a seasoned financial services leader and entrepreneur with over 2 decades of experience in banking, analytics, and digital lending. Of IIM Bangalore, he started his career with Standard Chartered Bank, where he established and scaled the analytical team. In 2007, he founded Net Positive and expanded it into a global analytical enterprise, serving leading clients across US, Africa, UAE, Australia, and India. Net Positive was later acquired by Equifax in 2014. He is currently the co-founder and chief executive officer of Finable. He is also an active angel investor, startup mentor. A very warm welcome to you, sir.
Thank you.
Our second panelist is Vimal Sahu, Chief Executive Officer, Early Salary Private Limited. Vimal is a chartered accountant and comes with an experience of over 23 years in banking and credit domain. At Early Salary, he focuses in building real-time credit risk profiling system and is spearheading credit risk, underwriting, and operations. Prior to joining Early Salary, Vimal was associated with Edelweiss Group as a business head, agri-commodities. He was also associated with Axis Bank as head of analytics, where he managed credit card business operations functions and led analytical functions for the entire retail asset portfolio. He was also associated with ICICI Bank earlier. Vimal has wide experience in managing unsecured lending in credit policy, decisioning, operations, analytic function, collections, call centers, etc. A very warm welcome to you, sir.
Thank you. Thank you, Vineet.
Our third panelist is Siddharth Viswanathan, Chief Rating Officer for CareEdge. Siddharth serves as a Chief Rating Officer at CareEdge. He has over 2 decades of experience in consumer lending and fintech ecosystem. At CareEdge, he heads the risk function with a special focus on development of scorecards, risk models, business intelligence unit, policy formulation, and analytics. He had also served as Chief Strategy Officer of CareEdge Services Limited, which was the parent entity, and has played a key role in designing and development of tech-driven risk platform for Indian consumer lending space. A very warm welcome to you, sir.
Hello.
In case participants wants to ask any question on the presentation or otherwise, they are requested to key in their question in Q&A panel on the screen. Now we'll begin our panel discussion and simultaneously take questions from the participants also. I take liberty to start with Nitin and request him to share his thoughts, opening remarks on the presentation made.
Thank you, Vineet, for a warm welcome and good evening to all the viewers. I think a couple of takeaways from the presentation. One was that compliance, the unification of NBFC and fintech, which is happening. Because of which the entire compliance angle in the fintech's life is becoming stronger and stronger, right? If they have to behave like NBFC, if they have to unify with NBFC, they have to behave like one, right? That's one of the key takeaway. The other key takeaway, which we all know, but when it comes in data like this, it makes it even more sharper, is the fact that NBFCs are taking away a large market share of new disbursements, right, as compared to private banks and PSUs. I think this data in some form or the other keeps coming to us, but I think it was overall a good refresher course, if I can say that, in what's happening in the industry.
Great, thanks. So we have actually started getting questions. So maybe I can put first question to Vimal. The question is largely on the MFI bill that Bihar has recently introduced. So the question, there are two questions largely. One is, what is the impact of that on the unsecured lending companies, and what is the impact on fintech portfolio?
So primarily on the MFI side, so largely if you really see the fintechs, I can classify broadly even in the fintech NBFCs also, there are very specific companies who do very ultra short term, ultra small ticket size loan, which is like, less than 25,000 and greater than 25,000 or 25,000 to 5 lakh rupees kind of loan. So there could be impact on the companies or NBFCs who or fintech NBFCs who are doing primarily the up to 25,000 rupees loan. That's where there will be good overlap on the MFI side. But the people who are doing more than 25,000 rupees ticket size loan, there is a hardly overlap between the MFI customers and the retail customers. So I personally feel that for the in general there may not be large impact, but for the some of the fintech NBFCs there may be impact who has a large overlap on the MFI side.
Okay. Continuing with you, Vimal, we saw that unsecured personal loan growth has moderated after RBI action
Yes.
on risk weight in 2013.
Yeah.
And if you look at recent data, the growth seems to have picked up again. So do you believe that the slowdown in growth has bottomed out and we are in for a high growth phase again?
So I would call it as we will not go back to the earlier growth rate, but the like as we saw in your presentation that growth came down to 9% in 24-25, and this year I think so we are looking at close to around 12 to 15% kind of growth rate, annualized growth rate. So my sense is I think so it should range between 15 to 20% or near about that range in the unsecured lending, overall lending space. So I would not call it as that we will go back to the earlier for 30+ % kind of growth back at least for a year or two. But yeah, I think so. I would still feel that 15 to 20% growth is expected and could happen. I think so. Overall unsecured lending, or yeah.
15 to 20% growth is what you're saying.
Yeah.
It's pretty moderate.
Yeah.
So there are a couple of different questions on credit bureau actually. So basically, these are questions pertaining to usage and effectiveness of credit bureau scores. We also have come across instances where borrowers with high credit scores have shown higher than expected delinquencies, especially in the segment where fintech operates. So maybe this question is to Siddharth. Uh, are there studies which have do the back testing of credit bureau scores with the defaults? Have you done any kind of that work? What is your view, the relevance and effectiveness of these scores?
Hmm. So, I guess let me kind of break down whatever information that we get from Credit Bureau into two very distinct data points here, data segments, right? From the point of view of how is it that we can kind of build a lot of signals and variables based on the raw data itself, and start looking at it from the point of view of how is it that you want to build your own customized scorecards, which is conducive towards the loan product that you want to offer. So, for example, even within CredP, right? So there can be multiple bureau scorecards for different type of products. Again, direction is similar in terms of thematics to what maybe Vimal kind of briefly alluded to as well, right? Small tickets, large tickets, tenure of the loans, these all would have a lot of indications and directions with respect to the way in which you want to build your scorecards as well, because the predictors also will be kind of different for each of these. So yeah, I think that's where I think we kind of have been running with our capabilities, and definitely I think whenever we build any kind of a scorecard for a specific loan product, it is always done with the older data, and then once the validation testing also kind of happens, subsequently the out of time testing pretty much gets done on the real time instance, right? And then you pretty much kind of run with it. So that's how the methodology really comes into the picture. So yeah, I mean, bureau scores are great because they give you a directionality. But if you really want to kind of go through your fine-grained approach of having a lot more directionality with respect to the expectation of risk management, it's always good to build your own scorecards based on the raw data.
Nitin, any take on this?
I completely agree with Siddharth that the bureau score is a generic score, right? If customer has, let's say, taken a gold loan, right, and that's the only loan they have served, how do you use that behavior if you are lending a personal loan to that customer? So, it's very, very generic. B, the amount of data that is going into the score is very limited, right? Bureau has only that much data available, which they are putting into the score. Whereas if we financial institutions or fintechs are building our own score, available, right? And data is the new oil, right? So we have multiple alternate sources from which we can tap into customer profile, the bank statement, the mobile apography data, and whatnot. I mean, the social profile data. So if you build all of that for a particular product that you are selling, obviously that would be much more powerful than a generic bureau score, right? So that's what we have also seen.
In fact, there was a question on this only, Nitin. Many fintech lenders claim to use alternate data for underwriting in practice. How much does it really improve credit risk assessment? That's the
Yeah,
precisely the same question that was.
yeah.
Then there is a follow-up question on which next state after Bihar. I think the panelists would be as good guessing as anybody else would be. So we'll pass that. Another question that has come is basically there are multiple reports saying that the real income is not rising in India, and Gen Z particularly have got over-indebted. So how do risk people see this? Maybe Vimal or Siddharth can take it.
Sure. Vimal, do you want to take a first pass at it, or should I go for it?
Go for it. I'll just jump in. Maybe.
Great, great, sure. So yeah, let's kind of talk about Gen Z. I mean, not trivializing or generalizing them, but I think the way in which the inherent behavior of Gen Z is probably a little bit more on instant gratification to the extent possible, which is why I think there is a reasonable amount of demand that has come in for unsecured loans as well, right? They are pretty aspirational in nature, and pretty much for that, if they really want to, let's say, get an iPhone or whatever it is. I think there was some article recently which said that enormous percentage of iPhones which are getting sold is all pretty much on loans, right? And that is a very interesting anecdote if you really think about it. that guys for whom the average age, the median age is kind of sitting at around 24, 25, 26, more or less, that is like the sweet spot for all the fintechs as well. And that's where your Gen Z, let's say, population also kind of starts overlapping, right? I think the other aspect really to kind of think about it is from the point of view of, let's say, leverage as a theme, which has been running in the unsecured segment for the last, I don't know, 1.5, 2 years now. And this kind of coming in from top, down, sideways, whichever way you kind of think about it, right? Now, I think it has kind of April, May 24 is where was one of the key criteria because of which some amount of stress had kind of come in at that point, is the hypothesis which is kind of running around in the industry, right? What has really happened is so the way in which I kind of see unsecured industry is like a sinusoidal curve in some ways, right? In the sense that whenever the risk increases, people kind of become conservative. Anyways, it has to organically go down. And then when it starts going down really low, then that is when people kind of push the pedal, which is, I think, an extremely fair way of looking at it. But I think there is another take at it wherein the thing is, instead of you kind of thinking about it as, let's say, a sinusoidal curve in terms of how do you really want to run with your credit risk, you kind of start tending it or pushing it towards, let's say, the centralization portion, right? So that is where you will pretty much start getting your equilibrium. And that's where we are kind of trying to push in certain, so whatever leverage components and scores, limitations, whatever we had kind of put in long time back, that, by the way, is still applicable for us, because the idea really is that it's always good to kind of have that equilibrium and hence a little bit of predictability across in your system. One good thing that anyways happens is whenever there is a subsequent to, let's say, a stress event, right? You always will have a lot of your negative stamping on the bureau, and hence whatever you kind of continue to run as your underwriting rules, that will pretty much give you the best of the customer segment, irrespective of whether you do any change on it at all or not, right? So that way, it is like a slightly more simplistic way by which you can start managing it. But yeah, leverage, I think, is one of the key themes that we all have to be extremely careful of. And if you really work backwards on leverage, I think the components really are twofold, right? One is how much of outflow in terms of your EMIs that are coming in, and what is your income. Now, income estimation, imputation, whichever you kind of think about it, unless there is a regular source of income, it is a slightly fungible concept, or it's a slightly vague concept if you really think about it. So, what would be the income of, let's say, a business, right? It would all be, you can kind of think about it as, let's say, the cash flows that are kind of coming in, because the thing is, at the end of the day, a business typically is a very cash flow driven kind of a business, right? It's not really a bank balance kind of a business. Whatever you get in your balances may not be really your income. It is just parked over there for some other concept. So which is where I think the maths around it really is something which is slightly experimental. Wherever you keep tweaking it and getting it to the right level in terms of identifying whether the person is over leverage or under leverage, is where I think the method to the madness really lies. But yeah, leverage is an extremely important concept that you have to be careful of. And to kind of tie it back to Gen Z, I think the propensity to take loans has been high, which is why you just have to balance and match it up as well.
Vimal, anything to add?
No, I think so. More or less, I think so. Gen Z specifically has, if you really see them, they are very aspirational in terms of thinking, in terms of, like, in our way back, 25 years back, when we used to earn 50,000 rupees, we always used to think that, I need to save 20 or 25,000 rupees for my future, right? But nowadays, today, Gen Z feels if I'm earning 50,000 rupees, let me live my life, let me, fulfill my aspiration. And, definitely in terms of India also going through that, consumerism is increasing. If you really see, like, for iPhone, which used to be 5-7% of the total phone sale, now it is almost like upward of 15% or 20% type, right? So which means that people are preferring more premiumization is happening. So and finally, at the end of the day, the another way to fulfill aspiration is taking loan. But at the end of the day, as Siddharth said, we need to be aware about the leverage, in case, as long as we feel that we are funding to the customers who are not over leveraged. I think so. These will remain. I think so. Those, yeah.
These issues largely are part of the model that you have developed. So, okay.
Yeah.
So, one question is, what is off balance sheet in the presentation you talked about? So off balance sheet typically would be BC partnerships as well as direct assignment transactions, and it would also include to some extent co-lending model, which is a subset of partnership. Then there is a question on what is the difference in business model of Credit B, Finable, and Five. I think that could be a separate webinar on that, so we'll park that for now. What is the propensity of fintech to bridge credit gap for MSME? That's a question. Maybe any of the panelists can take it.
So I think so. Maybe probably Nitin, you want to?
Yeah, sure. So, see, a lot of action in last, let's say, 5 years has happened in the consumer lending space as far as fintech is concerned, as far as innovation, disruption is concerned, right? And we strongly believe that that is yet to happen in the MSME lending space. Not to say it's not happened. Of course, there have been some early action in last 2, 3 years, but there is a lot more which needs to happen there, right? So, for instance, we have started doing loan against property around 6 months back, and we did the complete market scan, and we realized that still, even now in this day and age, the time taken to disburse is 8, 9 days, right? Whereas PL has become real time. I mean, there of course is a property angle validation of legal title and all of that. Even if you keep aside a day or two for that, even then 8, 9 days seem to be on the higher side. So, and I've heard that even Credit B has started loan against property, early salaries, also dabbling into a few secured products. So my sense is that the same fintech kind of growth we have seen in consumer lending, we will see in the coming 5 years for sure on the MSME side also, because the opportunity is huge, demand is very high, and the market is just ripe for disruption, I would say.
Yeah.
Nitin, if we go by the presentation, NBFCs have gained market share from banks, right? While NBFCs would comparatively have higher cost of funding, right? There are a variety of reasons why fintechs or NBFCs have grown in the PL segment in spite of higher cost of funding, which could include maybe better trade, maybe client centricity, maybe agility in terms of developing solutions, or maybe tech-based solutions, or ability to look at data differently and write based on data. All those reasons could be there, which would probably give a reason as to why it is growing. Now, the question largely is with more and more democratization of data and ability, maybe better ability or deep pockets of the banks to invest in technology, right? How sustainable would be the business case or the edge that the fintechs today have? What should the industry be doing to ensure that this edge is maintained and fintech and NBFCs continues to take market share away from the banks while the whole pie anyway is growing? So, what's your take on that?
So, I mean, if you have to structurally understand India financial services landscape, right? So there are around 45 odd banks. If we take private banks, PSU banks, and small finance banks, I mean, let's ignore the regional rural banks and other kind of the foreign banks. So 45 banks, and there are around 350 odd NBFCs in the upper layer, around 15, and around 320, 25 odd in the mid layer, right? Now that's a competition that the NBFCs are giving to the bank. They're just 45 of them growing at a very limited pace, right? They have to play in their customer segment, whereas NBFC is hungry for growth. 350 of them, some of them are even bigger than the banks in the country, right? So what do? They have to go for a customer segment which banks cannot cater to, right? I mean, if bank can give a loan to somebody, why would that person take a loan from a fintech or an NBFC? They will rather go to the bank, right? So NBFCs have to charter their own path. Now, their own path, one is, of course, the technology and all of that, which you mentioned. But I think the bigger vector there to play on is the appetite to take risk, right? Now, that appetite to take risk, we believe, is much higher in NBFCs, and therefore they are able to cater to a customer segment which was till now ignored by the banks, right? So, and this is not going to stop. I mean, if let's go with your hypothesis that banks will finally come into this segment. Now, even if banks come into this segment, how much of the share can they possibly take, right? Because then some other segment will open where the fintechs would want to run, right? So it will always be a growth story for fintech, which will be much faster because just the volume and the numbers there much faster than the banks.
Okay. Got it. Then there is a question on what are the pros and cons of off-book and on-book, specifically for a person who wants to start new. Nitin?
Actually, my most favorite question because
Yeah.
that's the biggest strategy discussion we have been having ever since we started on book, off book, or a mix, or completely pivot to on book. So if somebody is starting new, I would say it is best to start as, I mean, these are my views again, people can differ. If you're starting new, the best model to start is off book, right? Because to get to raise capital on day one, and when I capital equity is easy, what I mean by capital, debt is difficult, right? With equity, you can only raise that much. But when debt providers come, they will look for rating, they will look for maturity of the portfolio. How will all that happen on day one, right? So my advice to startup founders, look for an off book, try to build a decent size book where you have maturity of the portfolio you can showcase how good your collection is, your risk framework is. And once you have proven it, then proven the entire business model, then maybe you can start dabbling into own book, right? Because then own book debt providers start looking at you very, very favorably. And that's what we have done. So that's my short answer to that big thematic question, Vineet.
Yeah, thanks. I know this has been your favorite question. Coming to Vimal, there we have seen in the presentation there is a clear segmentation. The PSU banks are focusing on last ticket, then private sector are probably focusing on average ticket, which is maybe 3 to 5 lakh. And then you have NBFC which is focusing on a small ticket size. The question essentially which is coming from the participants is, do you see this trend changing, and do you see because of stricter guidelines around APR, NBFC is migrating to higher ticket loans? Do you see that kind of trend? What's your take on that?
Yeah, again, I think so. Again, as I initially started saying that there are two segments which fintech operates in, right? Within the fintech also, within consumer lending or personal unsecured personal loan, there is a ticket size which is small ticket personal loan, which is more like less than 25,000 rupees and upward of 25,000 rupees. My sense is, and these behavior as we rightly seen from the presentation also, risk increases as you go down the funnel, right? Because as you go smaller ticket size, the risk is also high. And those if someone needs to do that segment, they need to have a slightly higher APR or higher ROI product, right? And my view is that within fintech category, both will coexist, and many of the as you grow in the size, I think so you will move out of certain segment, and then that segment is taken by the newer entrant, right? And that's how it will keep on happening in the industry. So as an industry as a whole, I'm sure it will remain in these ranges, but it all depends on the which players will be new entrant who will take this share, which the larger or the slightly bigger NBFCs will vacate, will be taken by someone else. So it's a actually cycle which will keep on happening. Definitely that's how I believe that because there is a large segment of underserved customers whom, as of now, none of the banks or larger NBFCs are willing to cater to. And that's what I think. So those the 10 up less than 25,000 rupees ticket size NBFCs or the fintechs are trying to do that. So they will continue to be relevant in the overall ecosystem point of view. My sense is that.
There are a couple of questions which are maybe interrelated. One is on end use monitoring. So, since it is a personal loan, the end use monitoring may not be feasible. How does you look at it from the risk perspective? How does regulator looks at it? And then related question is there is a lot of noise that people have taken consumer loan and put that money into equity market. This noise has now slightly died down in last maybe 6 to 12 months time. But prior to 12 months time, this was a pretty hot question that people are borrowing and putting money into equity market, and as and when equity market goes down, the delinquencies of these lenders would go up significantly. So maybe Siddharth, you can take this.
Sure. So yeah, end use monitoring, as I think this is a regulatory requirement as well. Yeah, you pretty much have to look at the end use monitoring. Unfortunately, what happens is money is fungible, right? In the sense that you put it in one account. Let's say 100 rupees was there, you put in 100 rupees. Now, which 100 rupees of yours is used for what is where the cash really comes into the picture, right? So some of the directionalities with which we are kind of looking at it is twofolds, right? One is building certain personas with respect to the type of let's say outflow which happens immediately after the loan has been disbursed, and this can be via your primarily via your financial transaction SMSs and so on and so forth. And if you have account aggregator with recurring consent as a framework, then more or less you could kind of get it from bank statements as well, right? So you start building across personas in terms of whether A, it is something which gets used for some kind of a consumption driven output. And again, the thing is, there are some ways by which you can classify the usage of it via some amount of directionality on the merchant VPAs, etc., etc. Right? So that is one way by which you kind of do it. The second really big aspect of end use monitoring is to ensure that it is not used for any speculative purpose, which is where your second question also starts becoming extremely relevant. Because the thing is, that is also kind of extremely interlinked. One of the things probably that was a theme, I think, in the last 12 months is along with the stock market, I think your gaming apps also was one of the equally, let's say, high resounding themes across that. Why if what if people are kind of using this money for like putting it in a lot of these gaming apps and so on and so forth. And that's where I think there were a lot of questions as well. So some of the things by which we kind of at least ensure that it doesn't happen is preempting it as a part of the underwriting itself, wherein we start kind of getting a lot of signals with respect to whether there is any kind of a speculative, let's say, avenue of this individual. And again, that is all dependent on your persona. So, for example, there are a lot of financial transaction SMSs to your gaming apps in terms of UPI outflows and all those things. You pretty much know that even though this money, whatever 100 rupees that you give, might not be used for gaming apps, this person is kind of is in that kind of a segment or a profile. And what we have seen is inherently the expectation of risk for these segments is on the higher side, right? So we start eliminating some of these things at source itself, wherein the idea really is that instead of giving the money and then saying that let's monitor whether he really uses this for something speculative or not, instead of that you preempt it and kind of close that out of the equation. Similarly, I think one of the things that at least we have seen is in the segment that we are kind of operating in, we at least for us directionally there have been limited amount of folks who have let's say KYC, KRA, and so on and so forth, who invest in mutual funds, right? So stock market is one, and mutual funds is the other. In places wherever the equity kind of goes off, that is something which is slightly questionable. But wherever we kind of look at it from the point of view of an investment framework, those guys end up being a lot more greater customers, right? So you pretty much start looking at persona building and try to preempt a lot of these end use monitoring, let's say, negative events out of the equation. So that's how at least we have started building it. And it's kind of worked out well because the thing is, I mean, case in point really is that when the gaming apps pretty much were stopped at an instant, right? There was no, let's say, spike with respect to your delinquency and all those things that started coming into the picture. So, which also kind of gives you validation that your framework is kind of working out okay, and that kind of gives you a lot more assurance that things are kind of okay. So that's how at least we kind of manage it. But yeah, definitely pipes with respect to incremental data points are the ones by which you can really build this framework. So account aggregator recurring consent framework is one of the great things which has actually come into the equation. And yeah, I mean alternate data, financial transaction SMSs, that is also one very good data source considering that it is enriched so much with a lot of these small UPI transactions. And with the advent of UPI being a lot more commonplace now, right? And the transactions of UPI has been kind of going through the roof. Feb was slightly lower than Jan, but overall, I think there is a considerable amount of growth with respect to the usage of UPI as a primary transaction medium. So I think this kind of helps a lot more in building these directional personas. Being extremely accurate about it is going to be tricky, but yeah, you can build a directional framework around this for sure.
Well, there are two, three questions actually, which are touching the same point. Maybe I can read one of them and then you can take it. In the ecosystem, we sometimes see situations where an account may be current on the one lender's book, but delinquent in another lender's book. How significant is this issue in practice? And what mechanism exists today to ensure that accurate and timely data sharing across lenders? And how does the provisioning work across both the sides in these kind of situations?
So again, I think so. Again, RBI has come back from January 2025 or 2026 onwards. The one is the time to submit the data to bureau has reduced, which used to be like monthly. Now it is now fortnightly, and now slowly and slowly a lot of people are moving to weekly or daily kind of submission to the data. So that reduces the gap between the information sharing, right? So basically, like one lender has a delinquent account sitting, and then the same customer comes to someone else, like he is unaware that that customer has become delinquent with one. So that gap is reducing. But at the end of the day, it is all about individual, NBFC or Fintechs, prerogative in terms of whether they want to continue giving the loan to the customers who are defaulted on someone else. And sometimes, it is very difficult to say someone has defaulted for 500 rupees or 1,000 rupees, and he is still running 5 lakh rupees loan, or a few credit cards, and why would he default on 500 or 2,000 rupees loan, right? So there may be some lot of these nuances. Definitely, in terms of if we see structurally a customer is defaulting on multiple trade lines rather than one of the trade lines out of 20 trade lines or 10 trade lines, there will be a red flag, and those are factored in. One is definitely on the bureau in general score as well, and second is also each one of us have built internal scorecard which factors lot of these data points from the bureau report and then decides whether the customer should be approved, not approved. So, overall thought is that one is why by reducing the gap in the information sharing will help overall ecosystem do a better decisioning. And so that is the theme. I would call it as is a very, very good progress, which the RBI has taken, and now more or less most of the people are sharing the data with the bureaus either weekly or daily. Some of them, many of them are sharing daily, so which reduces the gap. And then finally, at the end of the day, every lender has to decide whether they continue to lend to his customers who have defaulted or not.
Lastly, information gap may be limited and it may not be widespread, is what
Yes.
I'm hearing from you.
Yes.
So maybe Siddharth, you can take this question. Collections of small ticket loans remain challenging with respect to cost of collection. How do fintechs solve for this? Is prudent underwriting remains the only key to avoid getting into that situation?
Interesting question. Yeah. So yeah, I mean, I think the thematic answer to this again is prevention is better than cure for sure. Right. So one way by which you can anyways look at it is one is managing your expectation of risk. The second key angle, which I think gets somewhat bypassed to a certain extent, is uh, collectability and connectability more or less are correlated to each other, right? So what that really means is, let's say, if you're kind of looking at small tickets or small EMIs that you need to keep on collecting at multiple levels, right? So connectivity kind of becomes your biggest driver in terms of identifying whether, let's say, even if the customer is kind of slightly iffy, will there be any way by which I can kind of get in touch with this individual via telecalls and so on and so forth, or via bot calls, SMS, WhatsApp, etc. Now, right now, I think what has really happened is the communication framework has been enriched and there are so many different options, right? So AI bots also kind of work out extremely well right now with respect to collections. And we have seen that work well as well. But the prerequisite really to entire thing is the connectivity aspect. So I think some of these things has to be ingrained into your underwriting framework as well, wherein you start looking at it from the point of view of, let's say, the connectivity of the device itself or the phone number itself, where the individual would be available. I think the traditional way in which things were kind of working earlier was to understand whether he's staying in the same residence or not. But considering that we are kind of going a lot more digital with respect to disbursement as well as the collections, the connectivity across your digital, let's say, communication channels kind of becomes a lot more relevant. So I think this is one of the key aspects that ideally should be overlaid in the underwriting. And then subsequently, if it happens, it happens. There are a reasonable amount of incremental data sources based on which you can get additional, let's say, communication data points. So, for example, phone numbers and all via the bureau, etc., etc. You will pretty much do a lot of these additive incremental things to enrich the guys who have been kind of going into your higher buckets for collections. But it's always easier to kind of preempt the collectability for small ticket loans, because the thing is, in an ideal situation, you would like to front load most of the collections for small ticket, because the thing is, the once you kind of go to a slightly higher DPD, and when I say slightly higher, it is more like post 15 days itself, your rollover starts becoming a lot more higher. So always front load it and try to collect it the earliest. Those would be the two key themes really from the point of view of collections.
So, Nitin, I quite didn't get this question, but still putting it before you. How useful is unified lending interface, ULI?
See, a lot of it is available through multiple APIs that we have integrated in last 3, 4 years, right? So ULI kind of makes it more a composite repository of everything. I mean, be it, let's say, account aggregator, be it PAN validation, or KYC validation. So all of that is some form or other already happening. ULI kind of makes it all happen on one single platform. So, I mean, we have not started using it yet, so I do not have a lot of wisdom on it, but that's what my first cut understanding is.
Basically, putting all lenders on one platform so that the borrower can choose. Is that what it is essentially?
Oh, no, that's not what this is. This is for a lender on how to use multiple data sources and validation, triangulation of data, all that to happen on a more real-time basis.
I think this is a initiative by RBI Innovation Hub, RBIH. So the way in which that works is similar to account aggregator, right? So if you really think about it, account aggregator is just a consent framework. On one side, you pretty much have your entire banks and the data source. The second one is your data consumption pods. And more or less, AA pretty much is the intermediary which kind of manages the entire consent framework, whether you should allow the data pipe to kind of pass through or not. Similar to that, I think RBI is building this intermediary, let's say, standardized interface on which, let's say, lenders can integrate. On the other side, by the way, like what Nitin already mentioned, there are a lot of these individual data sources or data pipes which are there. So for the guys who have kind of started their business earlier, they would have directly integrated it to them.
Yeah.
But the thing is, ULI pretty much it's like a single integration point, and then you can start consuming in any and every data sources that you want. to start using it for your underwriting. So that way, I think the barrier to entry has kind of reduced considerably with ULI. But I think over there also, they pretty much are kind of trying to onboard each and every lender sequentially and trying to scale it up. So that's how that is kind of working on.
We actually didn't expect so many questions. There are many questions still to be addressed. So we'll not be able to take all the questions, unfortunately. I'll put last question to maybe Nitin, and then others can add to that. So if you look at last couple of years, there have been significant changes in the CLM regulation, DAG guidelines, right? CLM 2 now has been discontinued. CLM has now been expanded to non-PSL also. So specifically in co-lending, how is the framework working on ground under the new guidelines, and what real-world challenges are you seeing in infrastructure, technology, loan pricing, accounting? How does that work for the sector?
I think we are quite gung-ho about whatever has happened on the regulatory side in last few years. So because there was a complete onslaught of fintech lending, right, in 2016-17 onwards. I mean, nobody knew how to react. Nobody knew how to put controls in place. But once that knowledge is available now, we have seen maturity of the portfolios. Even regulator has seen that. So the new regulations which have come, like for example, on the FLDG itself, right? Initially, when the business started, lenders, fintechs were giving 50%, 100% kind of an FLDG also, right? When they started. So that means there is absolutely no clue on what the risk framework is. Why would you give 100% FLDG otherwise? But that slowly, all that has been put into a framework. There is a 5% FLDG cap, which means that any kind of weird program which where I'm expecting a 20% loss rate will not get approved by any bank or NBFC now, right? So I think all those, if you pick up each and every kind of each and every new DLG guideline, you will actually understand the meaning behind it, and it is very well intentioned to bring lot of discipline in the mad rush that was happening over last 4 or 5 years, right? So going forward, things will only become better because there is so much of clarity now. Now even the investors understand that FLDG, how does it work? There is a 5% cap on it. Provisioning, everybody understands, right? How NBFCs are supposed to provide if they are doing an FLDG business or not. On every which way, there is much more clarity. And with this, things are only improving with every passing day, Vineet.
Suppose you have FLDG or SLDG of let's say X%, which is agreed, right? And eventual losses are higher. How does it impact this transaction, future relationship, future flow of facilities from the lender? Any sense on that?
This transaction is already sealed. There is a cap of
Right.
5% which RBI has put. There is no way anybody
Right.
can do anything about it, right?
Right. Right.
But the business is a continuous thing, right? So I will again go to the same lender asking for more lines in the future. So those lines will not be available at the same rate at which, or they will not be available at all if I'm showing like 15% kind of losses against 5%, right? So if I have to work in the framework of 5%, I have to make sure my losses are in that same framework, right? Otherwise, I'll find it difficult to grow business.
Okay. So basically saying that the transaction done is done, nothing can be done about it. But certainly the cost of next transaction or the rate of next transaction will get impacted because business model risks have turned out to be different than what was originally envisaged.
Yeah.
I thought that was the last question, but if panelists permit, there is one question which has come on credit cost and Roma. So I'll just put it maybe Vimal, Sabu, and Siddharth Nitin, all three can reflect on this. So when we look at the presentation also, fintech lenders typically operate with very high NIM, maybe 18-20%, right? And they have credit cost of 5, 7, 8, 10%, right? Whatever that number may be, let's say 6%. And they have ROA or maybe return on managed assets of maybe 2%, 2.5% that we have seen in the presentation. Now, the question essentially is the base credit loss number, which is at 6%, let's say, right? And we know that the borrower segment that we are dealing with could be more riskier or maybe more susceptible to economic shocks, right? In this context, the credit cost multiplying, right? 6 becoming, let's say, 9 or 6 becoming 12, right? Can't be completely ruled out. right? That's a potential risk that goes in the mind of the people. How does you model that in your model? Does that really worry that the base number itself is high, so any disruption could have multiplier effect on the credit cost and completely wipe out the profitability? So how does this angle plays out in your model, in your mind? What's your sense on this?
Yeah, so I think so. Again, as I said clearly, fintech also operates in different segments, and in general, I think so 5 to 6% is the range which I think so most of the annualized credit cost for the most of the fintech would be, right? And 6% going to 12%. I think so. It is unlikely, but yeah, 6% going to 8 9% is where in most economic downturn scenario might happen. And here again, most of the fintech also operates in very not large tenure product. See, today, unfortunately, when you give 5 year loan, you are stuck with that customer for 5 year. Whereas most of us or most of fintechs operates in, anywhere between 12 to 15 month kind of loan cycle. And the segment which most of us, barring the less than 25K segment, I'm sure operates is we have some visibility, and even if at least his income and his repayment capability. We keep looking at most of us keep looking at it in terms of his behavior on us, offers very regularly, right? So we can always cut off the customers for the next loan or next cycle. Although once loan is given, we just need to keep looking at his repayment behavior. But for the next loan, we can always look at, and that's the play I think. So most of the fintechs are playing that we are not playing in the 3 year, 4 year, 5 year product because of the same reason as clearly spelled out. Because there is an economic downturn which could happen, and if you're given 3 year, 5 year loan, and so you could do hardly anything in case something goes wrong in the economy, like six becoming 9 10 could be possibility, right? I'm not denying that fact. For I think so for us, we keep looking at the customer segment, customers persona, customer behavior on us very regularly, and keep looking at that customers, keep taking those decisions very quickly. So that's how I think so we are managing it.
Yeah.
Is that your take?
Yeah, no, I think that's right. Monitoring is one of the key inputs based on which you can pretty much tweak in your subsequent decisioning engine and so on and so forth, which is why I think that's where the tech in the fintech also starts becoming relevant. And that's what I think is the way in which the systems and as well as the teams have been built as well, right? The only other angle really would be, again, to kind of paraphrase your question really is that what is the probability of a variance kind of increasing, right? Or your standard deviation becoming plus 1 SD to plus 2 SD is what technically you're kind of talking about, right? So that's where you pretty much need to look at your segmentation, and within that, what is the variance across in each of these segments, and try to optimize on the distribution of your extremely limited deviation segments versus your extremely aggressive deviation segments. Wherever you see that the variance is really high, those are the ones which ideally are sensitive, extremely sensitive to any extraneous events. And hence, you would try to kind of reduce either the tenure for that, or would like to limit the exposure of those kind of pockets in your portfolio, right? That would be the way in which you would kind of play this, because at the end of the day, I mean, you would try to manage that overall credit risk as one single number, but within that you have so many opportunities of building really small products in and around it, right? So that's where you can pretty much play it around as well. I think at the end of the day, I think my philosophy is, or at least the way in which we have kind of driven it, is that you should try to build a product for each and every individual. Now, a loan product for each and every individual. The only thing is, where are your riders that starts coming into the picture from the point of view of the interest rates and the APRs that you have to kind of cut off, and which is where I think one of the feedback was that you start reducing on wherever the APR cuts pretty much kind of keeps on happening. There would be a pocket of customer segment that you might not be able to serve, primarily because the expectation of risk for that entire population is going to be slightly higher, and hence you would not be able to make any kind of a profit around it, right? So that's where you start eliminating some of those pockets. But the thing is, everything else is there for the taking. How do you really kind of build your entire portfolio based on the sum of the parts, and the distribution of that is where the game really lies. So yeah.
Good. Nitin,
What
your
I,
take?
what I would say, Vineet, is that see, there's a concept called recession loss multiplier, right? Now, when the recession hits, then have you stress tested your portfolio? How many times can your loss increase, right? You mentioned 2 times. Vimal was mentioning 1.5 times.
Yeah.
So,
Yeah.
good news for all of us is, or actually not good news, but the COVID happened and we have all stress tested our portfolio, right? We know what is the worst that can hit. COVID is like 1 in 100 event, right?
Yes.
In COVID, let's say if you have doubled your losses, then is your NIM good enough to take care of that doubling of losses, right? So the concept of risk of recession loss multiplier is that whatever is your NIM, can your loss when it is stress tested can be accommodated in that NIM or not. I mean, if you are working in that kind of a with that kind of a model in mind, I think you will not at least lose your shirt.
Yeah, I get what you're trying to say, and what we have largely observed is that entities have got a fairly range-bound credit cost. If I look at last 4 5 years, so hopefully things have stabilized, and as because this is a new asset class, right? And the APRs are too high. There are discussions around this. As and when the portfolio seasons and we have little longer track record, right? Probably these questions would be far more muted. These questions will never die because fundamental is that if the rate is high, the risk is high, right? How much higher that risk would be would always be time will tell us, right? Today
Yeah.
we are observing it at 6.5%, largely on an average basis. Whether it goes up, goes down, time will tell. This model is also evolving, and it is also getting fine-tuned, which is where it is. So thanks, gentlemen, for your time. Thanks for all the participants for attending this. This was really very helpful and insightful. Thanks, Vimal sir. Thanks, Siddharthi. Thanks, everybody. Thank you.
Thank you. Thanks,
Thank
Vineet,
you.
for having us over.
Thanks a lot. Bye.